Imagine this. You've finally decided to be responsible with your money. Every month you set aside a little cash, maybe $100, maybe $200. Watching your savings grow feels great. You feel more disciplined, more secure, and more in control of your finances. But one day you open your banking app and notice something surprising. Your savings account now has $10,000 in it, but after an entire year it has earned only around $50 in interest. At the same time, you keep hearing people talk about investing, index funds, compound growth, and building wealth. That's when a question pops into your mind. Am I missing something? Here's the truth. Saving money is a great habit, but saving alone usually isn't enough to build long-term wealth. And this is exactly where many people get stuck. They know they should save, but they don't know when or how to start investing. In this video, I'll show you a simple step-by-step roadmap that helps you move from saving to investing without feeling overwhelmed or putting your financial security at risk. If you're someone who has money sitting in a savings account and you're wondering how to make it grow, make sure to subscribe and like this video. Now let's begin. First, here's something that may surprise you. Saving money by itself will almost never make you wealthy. Don't get me wrong, saving is essential. But it's only the starting point, not the finish line. Think of it this way. Savings are designed to protect your money. Investments are designed to grow your money. Those are two completely different jobs. Let's look at a simple example. Suppose you keep $10,000 in a savings account earning 1% interest. After 1 year, you'll have about $10,100. Now imagine that same $10,000 is invested and earns an average annual return of 10%. After 1 year, it grows to roughly $11,000. At first glance, the difference doesn't seem huge, but time changes everything. After 20 years, that savings account would grow to around $12,200. The investment, on the other hand, could grow to nearly $67,000. Same starting amount, completely different income. That's the power of compound growth. In reality, the biggest wealth gap often isn't between people who save and people who spend. It's between people who save and people who invest. So why don't more people make the switch? The answer isn't math, it's psychology. Saving feels safe, your balance stays steady, and your money is always there. Investing is different. Markets rise and fall. Prices move every day, and that uncertainty makes many beginners nervous. Maybe you're thinking, but what if I lose my savings? That's a fair concern. And that's exactly why you shouldn't move everything into investments overnight. Instead, follow a gradual process. Step 1, build an emergency fund. Before investing, save enough cash to cover 3 to 6 months of essential living expenses. This money should stay in your savings account. It's there for unexpected situations like losing your job, medical bills, or emergency repairs. An emergency fund protects you from having to sell investments when life throws you a size. Step 2, separate saving and investing. Think of your money as 2 different buckets. The first bucket is your safety fund. The second bucket is your growth fund. Your safety money stays stable. Your growth money is invested with the expectation that it will increase over time, even if it experiences short-term ups and downs. Making this mental distinction helps reduce. Step 3, start small. Many people believe they need thousands of dollars before they can invest. That's simply not true. You can begin with as little as $50 or $100. At the beginning, the goal isn't making huge profits. The goal is creating a consistent investing habit. Small actions repeated over many years often produce amazing results. Step 4, keep your investments simple. A lot of beginners make the mistake of chasing complicated strategies. They jump into day trading, options, or highly speculative assets. But simple investing often wins. One of the easiest choices for long-term investors is an index fund. Instead of relying on a few companies, an index fund spreads your investment across hundreds of businesses. That diversification helps lower risk while still allowing your money to grow over time. Even legendary investor Warren Buffett has consistently recommended low-cost index funds for most people. Here's something many beginners don't expect. Successful investing is actually pretty boring. The real secret is consistency. Investing $300 every month. If your investments earn an average of 8% annually, after 25 years, you could have around $285,000. Yet you personally invested only $90,000. The remaining money came from investment growth. That's compounding working in your favor. Of course, investing isn't always comfortable. Markets will fall. News headlines will create fear. Many people panic during these moments, but disciplined investors think differently. Here's a simple analogy. Saving money is like storing seeds in a jar. The seeds stay safe, but they never grow. Investing is like planting those seeds in the ground. At first, you don't notice much, but with patience and time, those tiny seeds become something far more valuable. You may still wonder, what if the market crashes after I start investing? The truth is, market declines are a normal part of investing. History has shown that markets experience corrections and recoveries over and over again. For long-term investors, lower prices can actually become opportunities. Your regular investments buy more shares while prices are down, which may lead to stronger growth when markets recover. That's why experienced investors focus on years and decades, not days and weeks. So let's quickly recap. First, build an emergency fund covering 3 to 6 months of expenses. Second, separate your safety money from your growth money. Third, invest small amounts consistently. Fourth, keep your strategy simple by focusing on long-term investments like index funds. And finally, stay patient and let compound growth do its job. Because here's the biggest lesson. Saving money gives you security. Investing gives your money the opportunity to create freedom. When you combine both, you're building a much stronger financial future. If you found this video helpful, don't forget to subscribe and let me know in the comments. Are you still focused on saving, or have you already started investing? Because the moment your money starts working for you, everything begins to change.